Hi, so in this video we'll be discussing the concepts of debits and credits. So what these actual concepts are and what the differences are between the two of them. So as we've discussed in the previous couple of videos, every transaction that a business undertakes has two different effects on the account. And this is so that the accounting equation always holds. So if we go back and revisit the content of those videos very quickly, we had our accounting equation which said that assets equals liabilities plus equity, and we said that if a business was to, say, increase its assets by buying some machinery, in order to do that it would have to spend some money, and so it might borrow some funds to do that, and so they would increase their liabilities in the process. And so this transaction would be recorded in two places. It'd be recorded in our assets and in our liabilities, and the way this works out, it means that the accounting equation is always going to hold. This is always equal because when we've increased our assets, we've also increased our liabilities, so the left side and the right side of this equation have increased by the same amount, so our books will still balance. So that's all well and good, but what we're saying in this video is we're taking this a bit further, and we're looking at debits and credits, and we're saying that one of these increases we're going to call a debit, and the other one we're going to call a credit. And that's the next point here, is that every business transaction that happens, we have two effects on the account, and one of these is always going to be a debit, and the other one is always going to be a credit. And so the question is, how do we decide whether it's going to be a debit or a credit? And there are a number of say mnemonics or various devices to remember this, because it's quite a difficult one to just remember off the top of your head. So the one that I use is this DEAD, if my pen works, DEAD CLIC. There we go. So if we look at the first letters of each of these things, the D is obviously going to be for debit, and we just remember expense, asset, drawings, and so this gives us DEAD. And then credit gives us C, liabilities L, I is income, and C is capital. So what does this device actually mean? Well, this is for an increase. So if the entry into our accounts is going to increase our expenses, so we increase our expenses, well, that's a debit. If it's going to increase our assets, it's a debit. And if it's going to increase drawings in the account, it is also what we call a debit. And then the flip side of that is if we increase our liabilities, that is going to be a credit. If we increase income in the accounts, that's a credit. And if we increase capital in the accounts, that is also a credit. So the DEAD tells us which ones are debits, and the CLIC tells us which ones are credits. So if we went back to the example that we've been using in previous videos, which I've briefly touched on in the top right corner here, we said that if a business was going to buy machinery, and I think we said in the previous video that they were going to buy £20,000 of machinery, and let's say that they are using a bank loan, so just using a loan. So this purchase of £20,000 of machinery, this is obviously going to increase their assets. Increase assets. So what do we have here? Well, if we look at our DEAD CLIC, DEAD, I'll just write that out again just to emphasize that this is all we need to remember, DEAD CLIC. Well, we've got our A here, and this is assets. And as we said, DEAD CLIC applies for increases. So we've increased our assets. So this is in the DEAD section, so it's a debit. So this increase of assets is a debit. And now we know that one has to be a debit and the other one has to be a credit for every transaction. So we know that this loan is actually going to be a credit. And this loan is actually an increase in our liabilities. So that is a credit. And would you look at that, if we look at liabilities in our CLIC section, liabilities is actually there, and an increase in liabilities is going to be a credit. So that also checks out with our little device to remember this. Just a quick point to round this off is that the opposite is true for decreases. So obviously we're only looking at increases in these things here, but we flip this for decreases. So if we were going to have a decrease in assets, this is getting a little bit messy. We notice that assets is in our debit section for increases, but if we have a decrease in assets, this is actually then going to become a credit. The same is true for expenses. A decrease in expenses is a credit. A decrease in drawings is a credit. And then a decrease in liabilities will be a debit, decrease in income, and decrease in capital. These will all be debits because the opposite is true for decreases, as we see here. So this can be a little tricky to get our head around to begin with, but just with practice, with going through some examples. So we can just go through lots of examples. Say, think of assets. If they increase, it's a debit. If they decrease, it's a credit. And as we do more and more of those, we start to get very quick at deciding whether something's a debit or a credit. And the final point we've already sort of said here, but all debits must have an equal corresponding credit. And the reason for that is, as we've said, the accounting equation always holds. So not only does every transaction have a debit and a credit, but these are equal for every transaction, for the reasons we've discussed in the previous video. So I hope this made some sense. As I say, this is a fairly tricky topic to get our heads around, and it just takes a bit of practice. So a bit of practice can do no harm, and it might be a bit tricky to fully understand from a quick video, but I hope it was useful. And if it was, please do leave a like. Make sure to check out the playlist for other videos on concepts like this one, and subscribe to add some econ to your subscription feed.